David, stay with us because we want to bring in the rest of our Fox panel. Joining us now, we have Peter Schiff, author of Crash Proof, now the #1 best-selling investment book on Amazon.com. Wow. You owe us for that, Peter. We mention the book all the time.
We get a percentage.
We also have Pat Powell, Victoria Barrett, and Gary Kaltbaum with us. Peter, we know that you have supported Ron Paul as a candidate. When you hear from people like David say, you know what, Wall Street just wants a winner, what do you think of that theory?
No, that's not a good theory. No, Wall Street gets just about everything wrong, and I guess politics is no exception. I mean, the public wants change, and the reason they want change is because we're in a severe recession. We got runaway inflation. The only person that can deliver meaningful change is Ron Paul. He's the only one that understands the mess that we're in. He knows how we got into this mess, and he understands what's going to be necessary so that we can dig our way out of this hole.
Right. But we don't want to turn this into an advertisement for Ron Paul, by the way. But I do want to keep it to the fact of how it is, Victoria Barrett, that we are concerned that there might be a quid pro quo. That is, that the money that people donate, they hope to get something back for it, particularly if it's in the millions of dollars. Is there some kind of quid pro quo?
Well, look, people give money because they want to have influence. They also want to pick a winner. You don't want to give your money to who ends up being the loser. And if you look at the numbers on campaign funding, they have grown and kept pace with government spending, entitlement spending, subsidy spending. There's a very direct relationship, and the reason is if you're giving big checks, you're trying to get something in return.
Oh, yeah. Isn't that the case, though, Pat? I mean, you look at what Wall Street wants, and it was just about a year ago, I think, that John Mack of J.P. Morgan or Morgan Stanley, rather, had come out and said, you know what, we're going to go with Hillary for now. At least he said that he would support her. Right. Well, do you think he really felt that, or is he just going with the candidate he thought would win?
You know, there's a lot of cynicism on this panel today, but I think if you actually take the time and start reading the individual's economic plans, you start seeing a tremendous difference between the candidates. And I really like Huckabee as an individual, but when I read his economic policy, he's absolutely frightening. What he calls as a fair tax is basically the elimination of the IRS and putting in a consumption tax, which nobody knows whether this will work. When I read Obama's website and he starts talking about change, I start wondering, why would we want to change the largest and most successful economy in the history of the world?
Well, what's...
So I think when you start looking at this, I think there are some practical realities that start setting in.
Gary Kaltbaum, though, what kind of influence can those big donors have on the policy that comes out of these folks?
Well, as much as they can. Look, I don't think it's a badge of honor to be supported by any of these buzzard heads on Wall Street right now.
Buzzard heads.
After everything we've seen in the last year, you know what I'm talking about. But look, Wall Street is about, they're fair weather fans. Whoever's winning, they're going to go after, and whoever wins, they're going to be backing also. Why? Because they're looking for things. They're looking for better legislation to benefit Wall Street. That's just the way the business goes, and that's to be expected, and it's exactly what's going to happen going forward.
David, do the candidates care? Do they notice when they're quite aware of that kind of thing, where, oh, well, so-and-so was donating to John, John Thane was giving to McCain for quite some time, and then he quickly, if he were to switch, do they care where the money comes from?
As long as none of these guys are on trial for anything, they'll take their checks.
All right.
Okay, gang. Well, we'll have a lot more to talk about on politics coming up. Fox.
So the Fed is remaining very involved, obviously, in the housing situation. And, of course, as they watch all the other pieces of the pie at play, including inflation, is the Fed overplaying its role? Should the markets work out the problem on their own?
Let's bring our Fox panel back now to talk about it. Gary Kaltbaum, first to you. What do you think? Is the role of the Fed too intrusive, or is it just as it should be?
Much too intrusive. Look, I know these guys are out predicting, but I don't think they can tell you last year's Super Bowl winner. They have been wrong for the last year or two. And I have to tell you, this guy Plosser was out saying things are going to get better at the end of the year. There was another Fed head out by the name of Rosengren today that said housing is the worst in 50 years. There is mass confusion coming from these people, and that hurts the markets doubly on a day like today. I wish they would just go back into their room, play a little Nintendo Wii, and leave the markets alone at this point in time.
Yeah, can't you just see Victoria Bernanke playing a little Nintendo Wii? Not quite, but...
Yeah, probably bridge, right?
Well, what do you think, though? Is the Fed too intrusive? I like David's use of that word, because they do seem to be getting more and more involved in this picture.
Well, they are getting more involved because the public wants them to. There's a lot of uncertainty and folks want answers, and we're in a period where the answers are very unclear. The fundamental problem is that people have mortgages on houses, and the value of those houses have dropped considerably, and they're going to be harder to sell. The Fed can't change that reality. They can delay it by postponing payments, easing payments for folks, but I think overall that's going to do more damage to the credit market because creditors are going to start to pull back, and it's going to be harder to get money, and that will squeeze the consumer considerably. So I'm on the negative camp here, unfortunately.
Liz Clayman, should we let Peter Schiff Volcano just build more and go to him last? I think so.
I'm feeling the Mauna Loa effect with
Let's let it just build a little bit more. Pat, what do you think?
Well, Peter. I don't think that the Fed is sending out confused signals. I think the Fed is dealing with mixed information. You know, we have inflation that we need to be concerned about, and yet we have the economy that we need to be concerned about. Part of the Fed's job is to defend the integrity of the banking system, which has really been put under stress and strain with this subprime lending problem.
Lender of last resort.
Absolutely. So clearly the Fed has a role to play in here. The problem is that Fed's tools are not really appropriate for the problem that we have. In lowering interest rates, what they're essentially trying to do is drive the demand for credit up, and that usually gets the economy going. This is not a problem that we have a dearth of demand. The problem is we don't have a supply of credit, and therefore the Fed is very limited in how their tools can actually work to move the economy forward. The answer really lies more in Congress than it does at the Fed at this point.
Peter, Mount St. Helens Schiff, it's your turn to go off on the Fed. What do you think? Are they getting way too involved in this picture? They should just leave it?
Well, first of all, we have to remember that it's because of the Federal Reserve that we had the housing bubble in the first place. So they created the problem, and now they're making it worse by trying to cover it up with even more inflation. Real estate prices have to fall. You know, they had a real estate bubble in Japan in the 1980s, and then prices fell over 12 years by 70%. You know, we're nowhere near the bottom. Prices have to come down. They're much too high. They never should have got to the levels they got to in the first place. They have to go down. Unfortunately, when that happens, a lot of real estate wealth will be wiped out, and our economy is going to be in a severe recession. But that's the price we have to pay for the bubble that the Fed inflated in the first place.
Peter, I got to ask you, we know that you're for Ron Paul. We know how Ron Paul hates the Fed. How do you get rid of the Fed? Do you just declare tomorrow that it's gone? I mean,
well, I'm sure
what do you have to do to kill it if you want to kill it?
Well, remember, it didn't always exist. You know, it came into existence in 1913.
Nor did the income tax.
Yeah, and then, you know, we were still on the gold standard until 1971. So I'm sure there are ways to try to, you know, to wean our way back to honest money, to go back on a gold standard. We're going to have to do something like that, because otherwise Americans are going to see their savings completely destroyed.
You know, I just want to say to Gary Kalpon, though, Peter uses an interesting term here in saying the Fed covering up. And there are a lot of people who say, oh, we want the rate cut. But some people do consider that a cover-up of the real problems.
Look, I have to do this. I have to validate what Peter is saying. This Fed continues to put more liquidity out into the system for a problem that was excessive liquidity in the first place. The fact that they went down to 1%, the fact that they saw the subprime problem, enabled it, and absolutely, even Greenspan said, I didn't do anything about it, got us into this position. And I hate the fact that this is who everybody's looking to fix the problem.
You've got 10 seconds. Pat's dying to get in. Go ahead, Pat.
You absolutely have to look at what life was like before the Fed. We didn't have recessions. We had something called panics. You know, the Fed has done a very good job, but they are imperfect.
The Great Depression happened with the Federal Reserve.
Gotta leave it at that, Peter. We gave Pat the last word.
The higher
Markets really going down now. The Dow Jones Industrial is down 200 points. NASDAQ is even down a greater percentage-wise. The points don't look so bad, but it is. It's down over 2 percentage points. So at the end of this trading day, it is getting way lower.
All three major indices have tested and then broken through the previous lows, which were in November. Next stop would be the lows of August. Doesn't necessarily mean they'll get there, but you've got all three names having a very difficult time here, and leading it all countrywide, denying bankruptcy rumors. That halted the stock at the NYSE for a time. And then Bloomberg News is reporting that AT&T is warning of soft sales ahead, and that has made AT&T the percentage leader to the downside this afternoon. When you saw the Dow fall even more precipitously, that's very much due to AT&T falling.
There are also some other blue chips that are weighing very heavily on this index. American Express companies down 2.2%. Citicorp is down. JP Morgan falling about 4%. There you see an intraday chart of AT&T, and it has recovered off its worst levels of the day. But again, it's not acting favorably on the Dow Jones Industrial as a whole. Microsoft is also off about 2.5%.
But are the reasons that we talked about, such as Countrywide and AT&T, are they really the reasons the market's trading lower? Or have traders just thrown in the towel for now? Our Fox panel back with us to chime in on all of this. And Peter, why is the market trading lower today?
Well, I've been warning about the market for weeks. 2 weeks ago, I talked about the big head and shoulders top forming in the Dow. Last week at this time, I said the Dow was going to drop probably 2,000 points in the short run. The market is going a lot lower. This is a bear market. More importantly, when the Dow, last year, the Dow was worth 20 ounces of gold. It's now worth under 15 ounces of gold. In fact, I predicted in January of 2007 on television that the Dow would be worth only 15 ounces of gold by the end of 2007, and I nailed it. I think this year the Dow is going to fall to just 10 ounces of gold, and I think by the time this bear market is over, I might be able to buy the entire Dow Jones with just 1 ounce of gold.
Can you tell me who's going to win the lottery or what the lottery numbers are too?
I don't have clairvoyance, but I understand economics and I understand the market, so I can figure out that.
All right, well, let's figure out what's happening on the floor of the New York Stock Exchange right now. Tracy Burns is there. Tracy, why did the market go down so fast, so suddenly?
Because Peter's still trading in gold. I don't know. What the heck?
Hey, all my stocks are making 52-week highs today.
The markets clearly went down on the news that Bloomberg reported from AT&T because basically if AT&T is saying its consumer division is not doing well, that just means that recession is looming. People are not paying things, and so the market panicked on that and just plummeted further. Now, with the Dow Jones, Liz, as you pointed earlier, we went right through our November lows, and these August lows are coming up. 12.6 is a big number. Hopefully we don't blow through it, but as Teddy Weisberg just said, we probably will.
Yeah. Remember, the recession isn't looming.
Hold on,
it's here.
Let's get to Victoria. I want to work this around. Victoria, have the traders thrown in the towel? What's really at work here?
Oh yeah, I think it sounds like traders are pretty negative right now. There's the impulse is to sell, not to buy, but it's not a reason to if you're a consumer at home, it's not a reason to sell everything you own. The market's going to do just fine over the long run, but it's going to be a real rocky year. You should get out of financials because that's going to be the roughest hit. You should get out of home builders because I can see bankruptcies in that sector. It's countrywide, those are rumors just at this point, but it's not out of the question that we could see a real big company like that go bankrupt.
All right, but Pat, let's look beyond individual companies right now to what's happening with the indices. They're all taking a hit, down about 2 percentage points. Is this something, are we testing new bottoms now? Are we going beyond the August levels?
Well, we might. What you quoted before, though, you named one financial after another. Essentially, it's the contagion of if Countrywide is having a problem, what is the impact on the other financials? And the financials make up 20% of the S&P.
Sure.
So it drags down the whole index, and people are very frightened about this. And what really has to happen is you have to get beyond this a little bit and say, every company in the United States is not in trouble. You have a few companies that are in trouble. You have a few companies that you have to pay attention to.
Look, now the Dow is down 244 points. Gary Kaltbaum, does this day make you fearful, or do you lick your chops and say, what can I buy at a cheap price?
I really don't want to buy much. Look, coming into this new year, 70% of the market was already in a bear. Now we're getting the popular indices joining in. And the one word I haven't heard yet is earnings. Earnings have fallen off the cliff for retail, for semiconductors, and financials, and now we're starting to see it in AT&T, which is a $100 billion revenue company. That smacks of what's going to happen in earnings season coming in the next 2 weeks. I think the market's going lower. I think we'll get a Dow down 20% from the highs at least, which takes you under 11,000, and there's going to be more to go.
Really? 11,000?
Well, absolutely.
Peter Schiff, I heard you dying to get in here. Go ahead.
Well, we keep talking about the looming recession. The recession is already here. That's why all these earnings are disappointing. We're in recession right now. Don't believe the government statistics. Believe your eyes. Look at what's happening. And the recession is going to get worse. And on top of that, inflation is running out of control.
And to say one more thing, leading stocks right now are like Philip Morris, Procter & Gamble, Johnson & Johnson, all the recession-resistant companies.
Plus, all the stocks stocks that are making 52-week highs today, they're all gold stocks.
Reality check, though, Victoria, recession is defined, among other things, as 2 down quarters. So far, according to the government, I know that Peter doesn't respect the government stats, but so far, we're not officially in a recession.
Well, we might never officially.
Go ahead, Victoria.
No one has declared that, and it looks like we still have economic growth. If you look at what a lot of the economists are saying, it's lower than it has been, that's for sure. And there's a lot of things that concern me, especially the unemployment numbers that are creeping up, because that's going to take a real hit to consumer spending.
Who cares what these guys are saying,
I want to ask the booth if they can pull up Alcoa. The ticker symbol is AA. Alcoa appears to me to be the percentage leader to the downside. It is down 6% for Alcoa. And you look at all of these stocks in the Dow Jones Industrials. We've got General Electric, that's down 2.5%. Hewlett-Packard down close to 5%. A lot of these names are really getting hammered today. It's almost as if, and I think it was Gary Kaltbaum who said contagion, or was it? Yeah, and I don't know. You look at Intel down 3%. It's a tough day, particularly when Peter, a commodity company like Alcoa, which deals with aluminum, is getting pulled down by such a big percentage.
But look at the precious metal stocks. Look what I've been saying, and look at those stocks. Look what they're doing.
Yeah, 6%.
No, precious metals. Look how much they're
precious
up.
Metal. Well, yeah,
okay. Gold stocks are up 12% on the year.
Okay, and here we go with the closing bell. We have tested and...
You guys.
Okay, so what do we make of today's correction? Let's ask our Bulls and Bears panel, and it is comprised of Brenda Butner, along with Gary B. Smith. We have Tobin Smith, Pat Dorsey, and Peter Schiff all together. This is a great recipe for a good discussion here. I'll let Gary B. start here. Why do you think the markets fell like they did today? What's at work?
Well, I think it's one thing, Liz. I think people are afraid that, you know, we've already slid into recession. I mean, I don't think so, but I think people are afraid of that. And if not recession, then the next step, the big D word, depression. You know, people tend to think, oh my gosh, you know, what happens yesterday, you know, is going to happen tomorrow only tenfold. I think, you know, almost everyone I've heard for the past few hours on this show is saying, oh my gosh, you know, we're going to be at Dow 11,000, 10,000, 9,000. I'm actually kind of optimistic right now. I don't think we're going to immediately bounce and go up, but I think a lot of the selling you saw for, my gosh, almost all of January now is basically panic selling. People think we're in a recession, we're going to go to hell in a handbasket, sell everything.
Well, Toby, you know, the market doesn't always go step by step with our descent into recession. The recession is a very different thing. It includes companies that don't even have stocks, all the small and medium-sized companies that are not incorporated. So are we in a recession? Do you go with those guys who say we are?
Well, you know, listen, our numbers say no. Our numbers say that we've talked to about 14,000 of our alliance members. These are companies all over the world. We're in a slowdown. We're in a slower rate of growth. You know, you can argue while we don't have any numbers whether you're a recession or not. I'm sure Mr. Schiff will tell us all how he's never been wrong on calling anything in his life. But I will say that what you're going to see in this slowdown, a couple things going to happen. Number one, the Fed is watching today. And the Fed has come essentially to the rescue of the markets by adding liquidity in, by getting more behind the idea that we have more risk of recession than we do have of inflation, and they need to step up and do a table. I would love to see them, we talked about this last week, go into intra-meeting. They did that in 01. I remember when I was talking about Alan Greenspan making a 50 basis point cut before the meeting in 01. Everybody thought we were nuts, but they had saw this fall off. So we've got to think about the Fed. Same thing I got to think about is Gary's point, which is that panic selling creates, you know, opportunities if you're not going into a recession. The big question, you know, I can't tell you we're not going into a recession. I can tell you numbers say we're in a slowing rate. If I'm wrong, those markets are going down.
Okay, Pat, if Tobin's idea of an intra-meeting move, that would be a pretty dramatic move for the Fed. That means they don't wait till these particular meetings to make any kind of cut. Is that just slathering pancake makeup all over the face of an ugly market, and pancake makeup washes off eventually?
That's a great metaphor, Liz.
Yeah, I like that metaphor.
Leave it to a TV person.
Certainly you'd get a short-term bounce in the market. I mean, I don't think there's any question that the market would greet that positively. But again, we need to remember that whatever you do to the economy, whether it's monetary in terms of the Fed lowering rates between meetings, or whether it's some of these fiscal stimulus packages that are being talked about in Washington, it takes time to work its way into the economy. It would take 3 to 4 quarters to have any real effect on the economy. So I have been firmly in the camp of sort of a mid-cycle slowdown, not a recession, up until the jobs report last week. I'm leaning a little bit more, putting a higher odds of us slipping into a consumer-led recession. Not there yet, but the data continues to mount in favor of that thesis.
Mid-cycle slowdown or recession, Brenda, what is it?
Well, I think Pat makes a very good point. The thing is that the trend basically is going the wrong way. Even if it doesn't lead us into recession, we're seeing consumers borrow more, consumers using credit cards all during the Christmas season. We're seeing jobs not growing as fast as they could. As I think Tobin makes a good point, though, it's the pace of growth that is slowing. Now, does it go down actually? Do we actually start declining? I don't think so, because I think we're going to start to come out of the housing slump in the latter part of this year, and I think that is going to help the entire economy.
Gary B., does a day like today, where the markets fall triple digits for the Dow Jones Industrials and we break through those levels, do Fed members look at that, and I'm talking Ben Bernanke in particular, do they look at that even though they say they don't watch the markets too much, and then say, we got to do something now?
There's no doubt about it. Of course, they say they don't. They don't want to, relive the whole Greenspan put, turn it into a Bernanke put, which basically means they're going to put a floor, under the bottom of the market. But obviously they're looking at this, and if they do cut intra-medium, which I think there is a very strong possibility also of them doing that, they, of course, won't couch it in terms of what happened to the market. They'll talk about the subprime crisis. They'll talk about the economy slowing. They'll talk about lack of liquidity, anything but the market. But I definitely think they're looking at this on an hour-by-hour basis.
Peter Schiff, until Ron Paul is elected president, what happens to this economy?
Well, as I said, first of all, Liz, you used the word correction. We're in a bear market. The corrections are going to be when the market goes up. The primary trend is down. We're going a lot lower.
Which is what Brenda said. The trend is down.
Yeah. Right, but it's not a correction when the market's going down. We're in a bear market. It's going to go down, and it's going to go a lot lower. The economy, unfortunately, is going to sink deeper and deeper into recession. We're just at the beginning of this thing. We are unraveling the biggest credit bubble in financial history.
Well,
and
how will
our
it
entire
end,
economy.
what is going to? Every cycle has an end. What is the end of this cycle?
We're so far away from the end. There's no point in even discussing that. I mean, we're going to unravel from the excesses.
Indulge me, Peter. What is the end?
Look,
Dow Jones at 0.
Look, no. We're going to have a major collapse of our economy.
Negative, Peter.
If you let me explain, you get a lot of people poke fun at me for having gotten everything right. Instead of poking fun at me, you should just pay attention to what I'm saying.
But where does it end? I'm asking you a question.
Well, it's going to end. Look, we're going to have to return to a viable economy. We're going to have to start saving. We're going to have to start making things and exporting. We're going to have to live within our means. And unfortunately, those means have been dramatically diminished over the last decade or so because our industrial base has been hollowed out. We've got to stop printing money, and we've got to cut government spending and rebuild a viable economy. We can't live off the charity of the rest of the world.
We have to watch Dave Ramsey tonight. He always says, live within your means and live beneath your wage. Dave Ramsey's the man, tonight at 8 p.m. Eastern. Oh, boy, thank you so much. Let's ask our Bulls and Bears panel if the current hostile environment for business leaders is keeping the best candidates from taking the top jobs. Brenda, what do you think? Is it a hostile environment or is it a realistic environment?
Well, it's a hostile environment in that I think people hate CEOs now as much as they hate lawyers. And especially given this whole populist rhetoric that we're hearing. We're hearing anti-CEO down the line. But the truth is there's a lot of very good CEOs out there. And what happens is when you're in a stock market that's on a downtrend, you're going to see this because that's one of the problems about being a public company. If your share price is going to go down, you're going to get blamed for it and you're going to be kicked out. Sometimes you can't make the decisions that are necessary to make a stock price go up in the next month or so. That's not necessarily a good business decision. So,
of course, Toby, Jimmy Cain apparently did make some very bad choices this summer when this whole thing was going through its worst beginnings. He was out on the golf course. I mean, he owes some of his dismissal or his impending dismissal to his own actions.
Yeah, he was on the golf course allegedly. Jimmy Kane is a hands-off guy. Anybody knows Jimmy Kane, has known his style for 30 years, and he was not the guy who was suited for a meltdown. When you say hands-off, what that means is he trusts the lieutenants to solve his problems. The lieutenants couldn't solve the problems. Now, your question was, is this a bad time to be CEO? Well, frankly, I think it's a great time. Unless we're going into a bear market and Mr. Schiff is right again for the 100th time in a row, we have a situation here that look at Nardelli. Remember when he took over Home Depot? He did everything right. He got earnings up, he got volume up, he got margins up, but yet, he started in 2001. So by the time he got out, his stock options, the stock never went anywhere. He went out. Boy, you know what? I like to take over, and I've been a CEO of companies. I like to take over when stuff is tough, because then you get a chance the expectations are actually lower.
Yeah, nowhere to go but up, right?
Nowhere to go but up. Right?
Peter, it was so good to see you laugh and smile when somebody was teasing you, but is it a good time or a bad time to be a CEO?
Well, certainly on Wall Street has a major problem because these executives basically enrich themselves at the expense of their customers and their shareholders. And there's going to be a big backlash here. And Wall Street's going to have to change the way it does business. They're going to have to change these compensation structures, these bonuses, these options. It was all okay when they were private companies and it was their own money. But now that they're all publicly traded and they've got shareholders who they have to be responsible for, they can't treat them like patsies. And they can't treat their customers this way or they're not going to have any customers. They've got to stop giving out lousy investment advice, and they have to be honest with their shareholders and the people who are doing business with them.
Well, Gary B., one of the problems we hear very often is the fact that you get to be CEO, you get chummy with the board. In fact, you begin to put your friends on the board, and then they'll do basically anything that you want. They become a rubber stamp. Will that change?
No, I don't think it'll change at all. That is the history of, when these guys started out in college, they were all members at Princeton of the same eating club or the same fraternities at University of Pennsylvania, and I don't think that's ever going to change. And I think that goes in part to why I think it's probably a great time to be CEO. Look, Kane's out, right? Are we to shed a tear for him? No. What in the last few years he made? $28 million, $35 million. Look, the guy said for life. Well, I'll tell you what, this is probably, being a CEO at a Fortune 500 company is probably the toughest job, being next to an NFL football coach. But on the other hand, there's no shortage of candidates to be an NFL football coach.
Well, yeah, and then you have, Pat, you've got John Thain leaving the New York Stock Exchange, where he had great success to take on a real bear, and that would be Merrill Lynch.
Well, that's exactly the issue of low expectations right there. I mean, Merrill Lynch has nowhere to go but up, and it's actually a pretty cheap stock right now. What's happened, though, is that the pendulum has swung the other direction right now in corporate America. 10, 15 years ago, you pretty much needed to knife your secretary to get fired. I mean, it was pretty darn hard. And you still got paid on the way out the door, right?
Yeah, sure.
But
you got defended.
But today, we've gone in the other direction. Today, you are seeing, I think, a little bit more short-termism from boards who, at the slightest hint that things aren't going so well, they're ready to kick somebody out so the board doesn't get fired. This is what typically happens. The pendulum goes one way, pendulum goes the other way. We'll come back to something more approaching normalcy, but I do think some of the actions that have happened over the past, say, 6 to 9 months, you are seeing a bit of a hair trigger on the part of boards of directors, which is no better for corporate America than sort of letting somebody hang around until they knife the secretary.
Yeah. Brenda, about 20 seconds. Are we going to see corporations forced to do something from those inside the Beltway?
Forced to do something? Oh, absolutely. There's such a hue and cry against CEOs. Like I said, it's just a win-win situation on either side of the aisle to go after them.
All right, that's got to be the last word. Well,
We round out today's show with what you need to know, Toby.
I'm still laughing from David. What you need to know here is that...
You like my Farsi accent, eh?
Yeah, we've lost all of our Iranian viewers so far. You got to look at Huckabee right now and understand that after South Carolina, if he was a stock, I would sell him short. He runs out of gas. Giuliani's, strategy, which is, make or break here, starts to turn around in Florida, believe it or not. And so if you're on that in-trade system over in Ireland, I would be shorting Huckabee, and I would buy the Giuliani trade, because you can buy him for about $10. You will see a big boom. I am a Giuliani supporter.
You've already sent money to Giuliani. We just want to make that clear, correct?
Absolutely. But I'll tell you, it's setting up perfectly because Huckabee runs out of gas really right after South Carolina.
Let me get our Farsi viewers back. Az molegate shoma khoshbachtam, Gary B.
Fantastic.
Thank you.
Do I have to answer in Farsi then?
Yes, you do. Or we go on to Peter right away.
What do we need to know?
I'm sorry. I'm a little rusty. Yeah, here's a stock to buy. It's Starbucks. I know you guys talked about it a little bit in the previous couple of days. I think there's three reasons. One, they got their visionary back, Howard Schultz. Number two, the stock is down 50% from its all-time highs. But forget about those. Everyone thinks McDonald's is going to come in and beat up on Starbucks. I can tell you, in my experience in retail, the landscape is riddled with retailers who thought they could get more revenues and profits by getting away from their core competency. I think McDonald's getting into high-end coffee is going to be a lot tougher.
Do you own Starbucks?
I do not.
You do not. Scott Blyer bought it Friday.
Pat, what do we need to know?
Well, coffee is nice, but candy is dandy. I really like Cadbury Schweppes right here. They're spinning off
we all love it.
It wasn't in Farsi, I'm sorry. They're spinning off their beverage unit, which means they're going to be a pure confectionery company, which has better margins, and they have lots of room for margin improvement. You're getting a bit of a foreign currency hedge on it. It's about a $48 stock. Should be $60, $65 in a year's time.
You own it?
I do not.
Peter, what do we need to know?
Well, we learned yesterday that for the first time in over 100 years, per capita income in Great Britain is now higher than it is in the United States. And this shows a dramatic decline in our financial might, and it's going to continue. Over the next few years, we're going to continue to see our purchasing power eroded. I think a few years from now, per capita income in countries like Greece and Portugal will exceed that of the United States.
People need where is that fact from? I'd like to check that, because I don't
I know
find
exactly
the same
where
facts.
it's from, in fact.
Pat, where's it from? Pat.
It's from a group called Oxford Economics, and the problem with it is that it's measured at market exchange rates.
Well,
so
of course, how else could you
say
measure it?
That you do it by purchasing power parity.
No,
it takes into account the cost of
you
living.
don't. No, you
Stuff
have
is
Brenda,
cheaper
save
here in
us
the US
from
than it is
purchasing
in the
power
UK.
parity, please.
Okay, Toby always makes
this.
fun of me for what he calls my momisms, so I know I'm on track.
I love momism.
What is going on at the House of Mouse? They are now banning kids at Disney World from a restaurant. Yes. If you have kids, you can't go in. One of their fancy ones, it costs $125. So let me ask you a question. Why do you go to Disney World? Not if you don't have kids, right? You don't want to go watch a Small World
singles
forever.
bar.
No, that's it. That's the end of Disney World. I don't get it.
Wow.
Well, we are going to be watching the markets, everybody, tomorrow right here at this time. You've got to tune in to see how it closes once again. A tough day today.
Unbelievable day. The Dow was down 238 points. NASDAQ down even more. And again, what is going to happen tomorrow? We've got all sorts of warnings from Alcoa and others. Who knows?
And we will get those earnings from Alcoa. Stay tuned. And now it's happy hour. You know Cody and Rebecca will take you right through from the Bull and Bear Bar in Manhattan.